Welcome to an introduction to Risk Simulator Quick Primer, brought to you by Real Options Valuation Inc., the makers of Risk Simulator software as well as the Real Options Superlattice Solver, applicable for Monte Carlo simulation, forecasting, optimization, risk analysis, strategic analysis, and general statistical analytical tools. By way of introduction, I'm Dr. Jonathan Munn, the founder and CEO of Real Options Valuation Inc. I'm also the author of 7 books, including Real Options Analysis, first and second editions, Real Options Course, Applied Risk Analysis, Modeling Risk, first and second editions, Valuing Implied Stock Options, and others. I'm also the creator of Risk Simulator software and the Real Options Superlattice Solver, and we will showcase the Risk Simulator software in this segment. So let's now jump into the Risk Simulator software and see what this is all about. If you have Risk Simulator installed, all you need to do is start Microsoft Excel, and once you do that, you would see an additional menu item called Simulation. And under this menu item, you can access any of the Monte Carlo simulation engines and applications and tools from this menu item, as well as the forecasting methodologies, optimization processes, and general statistical analytical tools. You can also access some of these more commonly used applications from this toolbar, or these icons up here. If you need to know what these icons represent, all you need to do is hover your mouse over one of these icons and a pop-up will illustrate what each of these icons represent. So now let's get started with a simple model. In this case, this is probably one of the world's simplest models. On the left, we see a static model where we have revenue of $2 and a cost of $1. And therefore, the income in this case is $2 minus $1. A very simple model. Now, if you happen to know for a fact that your revenue is $2 and your cost is $1, then by definition your income will be $1. However, in a world of uncertainty and risk, we don't really know what the value is. Revenue may be around $2 and cost may be around $1, so income is going to be around $1. So in this case, $2 is a typed in value or an input assumption. $1 here is an input or an assumption. And that 2 minus 1, or G8 minus G9 in this case, is the output, or we call it a forecast in Monte Carlo simulation lingo. So now let's try to make this static model into something called a dynamic model. The first thing to do to create a dynamic model, i.e. to run a Monte Carlo simulation, is to click on Simulation, New Simulation Profile, give it a name. We can say Example Simulation if you wish. Set the number of trials. In this case, we'll say 5,000 trials. So you can set it to run 1,000, 100, or 100,000 trials, or 1,000,000 trials if you wish. But here we'll just start with a simple 5,000 trial simulation process. So let's come in here to the input and generate or create an assumption. So now that we've created a new profile, which is nothing but a new file for capturing all the assumptions and forecasts which we'll set up, is now to set an input assumption. So simulation set input assumption, or click on this icon right here, Set Input Assumption. And when you did that, you would see 24 different mathematical and statistical probability distributions in this case, from discrete and continuous distributions. So let's pick an easy one. Let's say a triangular distribution. Triangular distribution just means absolute worst case scenario, the minimum value, the maximum value, the best case if you will, absolute highest value, and the mode, which is most likely. So we did say revenue was most likely $2. Let's say the minimum is $1.95. So historically, you've gotten the least in this case was $1.95, and the maximum says $2.10. We can do that. And so now we've created an assumption: worst case, nominal case, best case scenarios, and so forth. We'll click OK, and notice that the cell turns into a different color, indicative of a Monte Carlo assumption in this case. So we'll come to cost and replicate the same process. Click on Set Input Assumption. And this time let's pick a very simple one, say a uniform distribution. Let's say cost has been uniformly between 90 cents and say, $1.50 historically. And we'll click OK in this case. Again, same color, this light blue-green color indicative of an assumption. And now we come and we set up a forecast in this case. We'll do the same thing, and we'll click on this icon called Set Output Forecast. Give it a name, say income, click OK, and now it becomes a yellow cell indicative of an output forecast. So now you've set up inputs and outputs, and all you need to do is click on Simulation and run simulation. Or we can come in here and click on this run icon. If we did that, what you would see is this Monte Carlo simulation being run. 5,000 trials. Notice it's going for 5,000 trials. It takes several seconds in this case. And boom, simulation has been completed. If we click OK, notice what happens. This value of my model is still 2 minus 1 equals 1. It doesn't change your model at all. The only difference is now we've created 5,000 scenarios around $2, around $1, and therefore the outcome of 5,000 alternative scenarios and sensitivities of income has been generated in this case. So what we see here is a nice risk simulator forecast distribution chart, which you can resize if you wish. I can type in here 90, hit tab, and it will create 2 lines in this case, which means the area in this body is 90% certainty, or 90% probability. So it's a 90% chance you will make between 54 cents and $1.08 in this case. Or I can come in here and select a left tail and type in, say $1, hit tab, and because it is a left tail, so left of this line right here is 80.04% probability. So 80% chance you will not hit your target. There's only a 20% probability you will hit $1 and above. We can do right tails, left tails, and so forth if you wish. You can also look at the statistics. In this case, we talk about the mean, the standard deviation, the average, the variances, and so forth. This is where one of my books would most certainly help, Modeling Risk, second edition, where you get in and understand what a mean is, what a standard deviation is, and so forth. And I also do a 4-day course and a 2-day course, a 2-day course on risk analysis, Monte Carlo simulation, forecasting, optimization, and a follow-up 2-day course on strategic analysis and strategic real options and risk analysis. Nonetheless, this is what your average or your mean value comes out to be, 81.84 cents. Now, this only represents one thing. The value I expect is $1, but the expected value is only 84 cents, the average value. You think you're making a buck, but you're not really making $1 in this case. So what you've done is literally created risk analysis, Monte Carlo simulation. So what if you have, say, 10 different identical projects? So instead of just one project in this case, you may have 10 of these, and let's say hypothetically you have 2 minus 1 equals 1, 2 minus 1 equals 1 for all 10. Now you can add an element of risk, not just return, not just saying everything is $1, which means you should be indifferent in selecting any of these projects. However, what if you can say project A has a 90% chance of making more than $1, project B has only a 50%, and C has a 10%, and so forth. Now you have added an element of risk, and it's very, very simple to do in this case. So let me close out of this example and show you another example. You saw the 24 different distributions a moment ago. However, sometimes you're saying, well, it's garbage in, garbage out. What if I pick the wrong distribution? Well, if you have historical data, in this case, I had typed in, say, 250 data points. You may have 10 data points or 1,000 data points and so forth. Select these data points, and you have no idea what this distribution represents. All you need to do is click on Simulation, go to Tools, and click on Distributional Fitting for a single variable. You may fit multiple variables if you wish simultaneously, but in this case, we'll fit this single to one variable. We'll do that. And you need to select either a discrete or continuous distribution. So discrete just means 1, 2, 3, 4, 5 as the outcome, or continuous where you have decimal points. In this case, clearly it's a continuous distribution. We'll make sure that by default everything's checked. So it will fit to all these distributions. We'll click OK. Wait for about a second and a half. And out comes this set of results where we rank the distribution. The best fitting distribution would in this case be normal distribution, then gamma, log normal, and so forth. So we can select any of these distributions and see the distributional fit compared to the empirical data, which are your bars in this case. Now clearly the best fit in this is a normal distribution with a p-value of 0.9996. One way of looking at the p-value is to say that 99.96 probability of fit in this case. So in other words, that's a pretty darn good fit. And you can also look at some of the more statistical, analytics in this case, Kolmogorov test statistics and so forth. Or click on OK, and out comes an assumption that's generated for you. So instead of having to pick and choose and garbage in, garbage out, you can actually use something called distributional fitting. And once you do distributional fitting, it will find the best distributional fit for you if you have some historical data. Now, you can apply this Monte Carlo simulation not to the world's worst model that you saw, 2 minus 1 equals 1. You can clearly apply it to a much larger model such as this. This is a discounted cash flow model, financial valuation model, or decision analysis model. And you can put in any type of macros that you wish, or complicated, mathematical computations in this case, if you wish, any of these things. And let's say we have inputs predefined in this case. Notice that we have this blue, green, cyan, color. Those are my assumptions. And here's my forecast. You can have multiple assumptions and multiple forecasts if you wish. And all I need to do is click on Run Simulation and notice everything is being run. And because we only selected one forecast, therefore you get one forecast chart in this case. So you're now doing risk analysis on a large and complicated model where all these interactions or uncertainties are changing, whereby I put in different assumptions in this case. You may even put in correlations among these products. For example, product A is correlated to product B, and B might be negatively correlated to product C, and so forth. And that is all doable in this case, and that is your final result. So again, we can come in and define each of these assumptions as you wish, and notice that we have different assumptions here, and if you make a decision, we can put in a correlation of say 0.5 or a negative 0.5 correlation and just rerun that again. And now you have a correlated Monte Carlo simulation. Next, let's take a look at a simple tool called a tornado analysis and a spider chart. So for example, if you have a simple model or even a highly complicated model in this spreadsheet example, and let's say your final result happens to be net present value. Net present value just means the valuation of your project. Now, you want to see what drives this final result, this NPV value, the most, given that you have created this highly complicated model or combinations of different input assumptions and so forth. All you need to do in this case is to click on Simulation, Tools, and click on Tornado or Sensitivity Analysis. In this case, we'll do Tornado Analysis. And Tornado Analysis, once you've done that, and because I have this cell selected, what it does is it finds within this Excel environment all your precedent cells. So in other words, if A plus B equals C, the precedents for C will be A and B in this case. So it picked up all your precedent cells, and you can make any modifications at this point. You can change some of the names, for example, if you wish, or change different ways of calling some of these input precedents, or you can change the percentage of upside and downside tests for each of these variables. So in other words, a sensitivity test. What if I would change this up 10% and minus 10%? What would the effects be? Let's click on OK and see what happens. Out comes a report that's generated. Here's your table. It talks about all your precedent cells that we looked at a moment ago. Now, we have, in this case as well, your base value was $96 million in your NPV. And if you were to change each of these inputs, so here's your base case value. So the investment value had 1,800 originally. So if you scroll down to investment, is 1,800 original value. But if you were to change this or perturb this plus 10%, it goes up to 1,980 or minus 10%. And what the upside and downside would be for your investment on your NPV base value. And we compute all that, and we looked at the one with the largest range to the smallest range and create something called a tornado chart in this case. Therefore, you're looking at critical success factors. What drives your decision the most? In this case, is investment, then tax rate, and then product prices for A and B, and the quantities, and so forth and so on. Now, looking at this, all we need to do is probably focus on applying Monte Carlo simulation and risk analysis on the top few variables and not worry so much as the numbers in the bottom have relatively very little impact on NPV analysis in this case. Also, on the right, we see something called spider chart. And spider chart just looks like a spider with its body and many legs protruding in this case. A positively sloped line just indicates a positively correlated set of variables. So in other words, investment in this case is negatively sloped, which means investment goes up, the value of your NPV or your value of your project goes down, and so forth. And the steeper the slope, the absolute value of the slope, would indicate that there's a higher impact, delta y over delta x. So the change in your y-axis to the change in the x-axis. X-axis is simply your base case is 0%, plus or minus, and so forth, how much it changes for each of your input assumptions, while the y-axis tells you what is your value of your NPV. So the change of your NPV, your objective, as a percentage change to the change of each of your independent variables, your present values, and so forth. So we can compute sensitivities and figure out which of your data parameters or your input assumptions are most sensitive, and therefore spend some time analyzing those. Then we have another tool called forecasting. And in forecasting, you can use multiple approaches to run a forecast. For example, if we have, say, a time series set of analysis, data, historical data, let's say we have sales values. And these sales are on a quarterly period. And it goes from, say, year 2000, year 2004. And we have this historical data, and it's clearly upward trending in this case. So the question is, what is the next period, next quarter? And let's say we want to forecast this for the next 8 quarters, or 2 quarters, or 4 quarters. Well, the way to do it is to select these cells. So from here, the historical data, go to simulation, click on forecasting, and there are a couple ways to apply forecasting. We have multiple regression analysis. We can use regression analysis to forecast time series, cross-sectional type data, which does not exhibit any type of element of time. Nonlinear extrapolation, where you have curves. Time series analysis, stochastic processes when you don't have any data at all. And in the next version, we'll have autoregressive integrated moving average, or ARIMA Box-Jenkins model as well. So let's pick one. Let's say a time series analysis, because we follow time in this case. So you can, if you understand any of these different types of methodologies, if you read my books or attended my courses, you will be able to come in and pick the right applications. Or if you don't, all you need to do is click on auto model selection. And what this software will do is it will go through all these different types of models, such as a Holt-Winters multiplicative model and so forth, and find the best alpha, beta, and gamma model parameters and optimizes it and finds the best model, best fitting model to forecast your data. So we always want to use auto model selection if possible. You can also put in seasonality. In this case, we'll leave it at 4 because it's quarterly data. And so there are 4 quarters to a year. And let's say we wish to forecast, 8 periods in this case. You can forecast as many periods as you wish, but clearly the more periods you have, the less likely, the accuracy and so forth, precision will not be as high. So we tend not to want to forecast too distant into the future. So in this case, all we do is we click on OK. And now we get a report and a methodology report. Let's take a look at the report real quick. Well, apparently the best model was Holt-Winters multiplicative. And here was the alpha and beta and gamma values and so forth that was being optimized. You can read through the summary that helps to understand what this report actually represents. And notice that we have forecasted, in this case, 8 periods going into the future, which is exactly what we had asked for. And notice that each of these cells are green in color. What that means is you can actually look at some of the assumptions in this case, and if we had previously selected generated assumptions, which means if I were to show you real quickly one more time, time series analysis, if you had selected automatically generate assumptions, what happens is an assumption will be generated. So this will be, say, a normal distribution and so forth. So rather than being a single point estimate, you've got multiple points. And here are your forecast values. Now on top of that, you can actually see this chart right here, which is very interesting because the blue dots and blue lines indicate your actual or historical data. Notice that there is clearly an upward trend and seasonality, so cycles along here. Now the forecast values are in red, and what that shows you also is it's a fairly close fit, a fairly close forecast. And in fact, going forwards for the next 8 data points, what happens is you see this upward trend as well, and you see the seasonality along this trend. So in other words, the methodology actually picked up the seasonality and the trend for you. And this is very simple to apply. We click 2 buttons or 2 icons, and the next thing you know, well, we have a forecast report in this case. And also, for those of us who are interested in the statistics, you can look at the root mean square error, the mean squared error, mean absolute deviation, mean absolute percentage error, tau z, and so forth. And I highly suggest that you do some read up on the error measurements using Modeling Risk 2nd edition, or take some of my training DVD courses, whether it's using the training DVD itself or live seminars and presentations and courses, to actually understand a little bit more about some of the error measurements and how to run a good and solid forecast using some of these different methodologies with stochastic processes and so forth. Okay. Next, let me show you something called optimization. Let's just say we have different projects, project 1 to project 10, or it could be asset classes. This could be, stock 1, stock 2, or it could be mutual fund 1, a bond, a treasury, type instrument, and so forth and so on. And now we have in these examples where each of these project or asset classes has its own returns and risk. And notice that I have these cells in color. What that means is each of these cells would have its own distribution. So in other words, I'm doing risk analysis in this case. So all these would have uncertainties around it. I think I'm making 10.54% returns, but historically it's been between, say, 6 and 15% and so forth. And the same thing for the risk. We can simulate that as well. And for each of these, because let's say we have 10 different projects, let us say we can allocate to each of these no more than 35% on each asset or project, and no less than 5%. So I'm choosing between 5 and 35% because I don't want you to allocate 100% to a single asset or stock or project and so forth. So I want to have portfolio diversification in this case. If you were to rank them by returns, you would see that project 7 and project 8 and project 6 will be the top 3. Compared to if you were to go with the lowest risk to the highest risk, you would have a different set of rankings. If you were to do return to risk ranking, which means return over risk, bang for the buck, you would have a different set of rankings, and so forth. It's very difficult to make an assumption looking at it directly. So what I do is I create something called optimization under uncertainty. So stochastic optimization and dynamic optimization when all of these things are changing. My constraint in this case is I have to allocate 100%, clearly. I cannot spend 101% of what I have or 99%. It has to be exactly 100% allocating across these 10 projects or 20 or 30 projects and so forth. Now, if I did that, then I would compute my sum product, which means a percentage allocation. So I'm making returns here times how much of these weights, returns times how much of the weight. Same thing with the risk. And what I'm trying to do is maximize this thing called return to risk ratio. So rather than maximizing returns, which means all you need to do is put all your money on the ones with the highest returns. Go all the way down to the least returns until you run out of money. Or if you minimize the risk, you would do the opposite. You would find the one with the lowest risk, put all your money in, and then move to the second lowest risk, and so forth until you run out of money. The problem is you're not really looking at returns in this case, and if you're looking at risk, you're not analyzing how much is it worth in terms of taking this amount of risk. Or if you're only looking at returns, you're not considering the risk. So what we do here is we look at return and risk ratio. And now you are also, in this case, we can correlate some of these assumptions. So in other words, we are looking at correlated simulation on the returns. And what that means is literally looking at a diversified portfolio of returns. So are you looking at portfolio diversification as well? So let's do that real quickly. So what you would do is select one of your allocation weights, click on simulation, optimization, and define this as a decision variable. Or you can select this cell and click on this as D, set a decision, give it a name if you wish, or you can link it. I can click on this icon right here, link it to project 1, and lower bound and upper bound. Again, I can link if you wish, or I can type in a value, 0.05 for 5%, 0.35 for 35%. So I've created this decision variable here. And I can replicate this all the way through, or I can select this, click on copy the parameter. Notice I'm using Risk Simulator copy and not copy in Excel. So I can copy that, select the rest of this, and click on paste parameter. And I've already done that for you, fortunately. So we're copying and pasting these different decision variables. We're saying these are the 10 decisions that we have to make, subject to this constraint. So the constraint, all we need to do is click on the constraint icon or simulation, optimization, constraints, add a constraint if you wish in this case. Now let me move this over so you can see what I'm doing. Add a constraint, and we can say this cell right here has to be equal to 100% in this case. And we click on OK, and we hit OK in this case. So what we're doing is we need to set everything to 100%. So each of these decision variables, for example, that is between 5% and 35%, has to sum up to 100% towards the end. Okay, that is my constraint. And now all we need to do is run an optimization. So click on Run Optimization. You can select static optimization, dynamic, or stochastic. Static just means run it without the simulation. Dynamic means do it with simulation. Stochastic means do it with simulation, but repeat it 10 times, 20 times, 50 times. Good at it to get a distribution of outcomes. So rather than saying you need to put in 10.65% allocation, well, the range is probably between 9% and 10.65 and so forth. So you have a distribution of optimal results. We can walk through this and make sure that the objective is set to C18, which is maximum of return to risk ratio, that your constraints in there, decision variables are in there, and so forth, and you can click OK in this case. And within about, say, 2 seconds in this example, it says optimization has been completed. Do you wish to replace it with the updated or optimal values, or revert back to your original values of 10%, 10%, 10%? Well, let's just say replace. So what happens is this is the highest return to risk ratio that you can ever obtain, subject to the sum of these values are exactly 100%. And we're saying put 11.09% of your project portfolio into project 1, 6.87, and so forth. And notice that all these values are all between 5 and 35% as we had prescribed previously. So we have done a portfolio optimization. We can come in here as well, do the same approach, and instead of selecting static optimization, we can do a dynamic optimization. Let's say, run 500 trials and make sure that your objectives are still there, the constraints, decision variables, everything's good. So if we click OK in this case, notice that now we're running a Monte Carlo simulation. So we're capturing the risk, the correlations, the diversification within this portfolio. And once that's done, now we're creating an optimization, an optimal portfolio around that. So it's risk analysis, forecasting, predictions, because we're predicting all these different values. We're using the analytical tools to generate distributions for each of these. And now we're allocating this using stochastic, or in this case, a dynamic portfolio optimization. So let's see how this works. There is another example. Let's say we have a discrete optimization, whereby instead of fluctuating between 5% and say 35%, such as the total is 100%, what if you are actually looking at projects, i.e. trying to figure out go and no-go decisions? So in this example, I've got 20 different projects in this case. And again, we have cells that have assumptions. So I may have my extended or expanded net present values. And these things could be linked from other spreadsheets or other models, if you wish, the different costs or implementation costs of each of these projects to implement. And also, we have risk to return ratios in this case. And now I've created decision variables or selection variables in this case. And notice what I've done. I've selected the cell, clicked on set decision, give it a name if you wish, and selected binary instead of continuous, which was in the previous example between 5 and 35%. Here's 0 or 1. That's what binary means. And I've copied and pasted this 0 and 1 all the way through for these 20 different projects. So 0 for no-go and 1 for go. Do it or don't do it. So there are 20 projects, the total here. The total NPV for all these would be this value times whether it's a go. If it's no go, then it will be a 0 value. This times this selection is 0. Or if it's times 1, then you have a value of 458 because you executed a project. And so it's a sum product of these two columns. Same thing with risk as well. And we can do risk analysis as well if you wish. So the idea in this case is, say, we can maximize bang for the buck, or we can maximize just total portfolio value, accounting for risk, uncertainty, and selecting the best projects. And we can put in things like budget constraints. In this case, if we were to execute all these projects, 20 of them, will cost us $10.2 million or $10.2 billion. Let's say we only have $5 million. These are all in thousands, by the way. So let's say we only have $5 million. So what are the combinations and permutations of projects that will maximize my total portfolio value subject to this budget constraint, subject to risk, uncertainty that I'm simulating, subject to the fact that, I cannot handle more than 10 projects, let's say. So I want anything less than 10 projects. Or even less than equal to 10 projects. I may be able to handle 10 up to and including 10 projects. In other words, I can also add in, if you wish, additional FTE requirements of full-time equivalences. So maybe project 1 requires 2 engineers, 3 pilots, and 5 managers, and so forth. And project 2 has a different combinations of requirements. And let's say I only have 25 engineers and 32 management individuals and so forth that you can allocate. So you can also add in all types of constraints, or you can constrain it over time and so forth. There are many, many things you can actually do. But in this simple example, let's just try to select the best projects in my portfolio. So it's portfolio management with risk and uncertainty. So let's come in here and run optimization. We can again use static optimization or dynamic or stochastic. We'll make sure that the objective is C25 in this case that we've selected. So we want to maximize this total NPV or expanded net present value for my project portfolio. The constraints are such that it's less than or equal to 10 projects, so J25 in this case. And E25, which is this value right here, has to be less than or equal to 5,000 or 5 million, depending on the units you use. And also, we have the different decision variables that you saw a moment ago. So in this case, I'll click on OK, and notice that it's running at the bottom in this case. You can see the solutions is going through, and it's testing all these multiple combinations and permutations, and within, say, 10 seconds or so, it's done. And we can say replace in this case. And the answer to maximize my total portfolio value is to execute project 2, project 4, project 6, 7, 8, 9, 10, 11, project 16, 17, and so forth, such that, guess what? The total number of projects that's selected is exactly 10, and the total cost that's being executed is actually under $5 million, and my total portfolio value is the highest value I can actually obtain in this case, in this different combinations. So if you were to do this by hand, it's actually 20 factorial, which is a very, very large number. It will take you probably the entire lifetime of the sun to come up with different combinations. Do I go with 1 and nothing, or 2 and nothing, and 1 and 2 and nothing, and 1, 3, and 5, and so forth? Different combinations. Very difficult to do. In this case, we're doing risk analysis, we're doing simulation, forecasting, optimization, and using statistical analysis to obtain the best combination of projects. You can also apply optimization and risk analysis for inventories. For example, you've got different cycles of demand, different seasons for your products, and you may have different parts. So part A, 512, and so forth, part V, 542, and so forth and so on. Now, what we need to do is find the best number of parts to manufacture for different parts and different seasons, if you wish. So for this third season, third cycle, this is the part number that we need to manufacture, subject to a lot of constraints, of course. First constraint is, well, each part cannot exceed 100 units or 100,000 if these are in values of 100,000 units. So I cannot manufacture 100,000 units in total. So this is optimization across time, across season. Now, each cycle, I can only make up to 250,000 units because, well, I have a small manufacturing firm, for example. I've got constraints. So some of these, for each of these cycles, cannot exceed 250 or 250,000 units. And the total number of parts for this whole entire cycle and all these different parts cannot exceed, say, 800,000 units. Now, what we need to do is find the optimal mix of manufactured parts subject to the uncertainty of each of these demands. So let's say each of these values, cycle 3 demand and so forth, has a distribution. So it's unknown. It's not a single point estimate. It's not saying you will sell 17,000 or 17 parts in this case. It's saying you can sell anywhere between 15,000 and 18,000 and so forth. Now, what is the optimal mix in your portfolio of parts that you need to manufacture such that you're, in this case, maximizing your total revenues? Because you may say, for example, every time you have a surplus, you have a inventory holding cost of, let's say, $1 or $10 and so forth. So you want to minimize this additional cost of having additional or too many parts. But at the same time, you don't want to have too little parts, because if you have not enough parts, you do not make that sale in this case. So it's all model in this case. And what we need to do is maximize my total revenues, the final output after all these things are integrated and changing. So let's run a dynamic simulation. So let's do some Monte Carlo simulation, do some risk analysis and predictions. So we don't know what these parts will be. Let's simulate them. The objective in this case is this cell right here, which is my total portfolio value, subject to a bunch of constraints. And the constraints here could be, these cells, K11, K14, which means these cells right here cannot exceed 250,000 or 250 as we talked about. So for one period, you cannot manufacture more than 250,000, units or parts. And for each part, you do not wish to manufacture anything, greater than, say, 100,000. And the total number of parts for this entire year is less than 800,000 in this case. And we, of course, have the decision variables that you saw a moment ago. So different cells and different values and so forth. So in each, for example, decision, you can only manufacture between 15 and 35,000. You do not want to manufacture less than that. You do not manufacture more than 35 and so forth. So we click OK, and notice what's happening is it is forecasting, it is predicting, it is using risk analysis or applying Monte Carlo simulation. It's predicting how many parts will get sold to begin with. So it goes through and it does all that. And now it's coming up and it is performing optimization, and now it's done. After, say, about 5 to 10 seconds or so, we'll hit replace. That's your answer right there. So for this season, for this part, this is the optimal number that you should be developing. So 24,647 parts of a part A 5112, given the price and given the manufactured values and so forth. And in fact, in other models, you can also do price optimization. So to maximize, total revenues, or how many parts you will end up selling and so forth, you can actually do an optimization on price itself, not just the quantity. So that's assuming elasticity, assuming uncertainty, your competitive effects, and forecasting what competition will do, forecasting how many parts you end up selling, and so forth and so on, while at the same time allowing for Monte Carlo simulation, predictions, and so forth.